Just in, the Fed's latest consumer credit report exposes Americans drowning in a record $5 trillion of debt, with banks hauling in a staggering amount of every year on credit card interest alone. Wait until you see these unbelievable charts revealing the scale of the squeeze. So, we got the Fed's latest G19 report. I'll link to it in the description. Remember, these are annual rates of change. Also, remember, private banks print the vast majority of the dollars in the system. So, this credit growth really matters. The rate of change of this credit growth really matters, as we will see in some of the charts. We can see overall consumer credit grew at 3.1% annualized rate. That is starting to pick up from last month. And if you look at revolving credit, think credit card interest, credit card debt or credit, two sides of the same coin. Consumers deleveraged in August, and they are starting to leverage back up. 1.5% annual rate of change there for revolving credit. Non-revolving credit, think auto loans, personal loans, that is picking up going back to July. We can see 2.2%, 2.9%, 3.7%. Now, just wait until you see the amount of interest that the banks are hauling in on credit card interest. It is absolutely unbelievable. So if we look at the total flow, again, that's an annual rate, $157 billion. Of that, $19.8 billion is revolving or credit cards. $137 billion is non-revolving. You can think auto loans, fixed term sort of loan, fixed interest rate, generally speaking. Now, looking at the interest rate, this is really important for one of the charts we're going to look at. You can see in Q4, the interest rate on credit cards assessed interest. So those that are not paying their balance down completely. This is an important distinction. 22.8%. Now, it has actually gone up to 22.83%. If we look at student loans, those are growing at 6.5% annual rate of change. Auto loans are growing at 1.8%. So here we can see the monthly total credit change, credit or debt. Remember, two sides of the same coin. We can see 13 billion, and again, annual, that equates to 157 billion. If you take the 12-month average, right now we are looking at about $130 billion of debt, in new debt, consumer debt, every single year. We can see the total amount outstanding is 5.08 trillion. If we look at components here, auto loan debt makes up 1.57 trillion. Student loan debt makes up 1.8 trillion. Again, remember, growing at 6.5% annual rate of change. And if we look at auto loan debt as a share of GDP, that has been declining going back all the way to 2020. If we look at revolving credit to really zoom in on this interest and this kind of ripoff that the banks are doing of the average American, here is the percentage change, the annual rate of change for revolving credit, for those credit cards. We can see growing at about 1.5% for this last release, but averaging about 2.5% over the past year. Now, if you look at total amount of credit card debt, that is at $1.2 trillion. Well, why this matters, if you take that the average interest rate, that on accounts assessed interest, and you apply it to that 1.2 trillion, it equates to $280 billion in credit card interest every single year, just the interest alone. Now, that is from a 22.83% interest rate, by the way. That is pretty astounding. Now, someone posted this as a reply to a X post I made earlier today, and I think it's a really, really good way of describing this sort of economy we find ourselves in. Interest, asset owners are benefiting. They are the upper leg of the K, reaping in, for example, $280 billion of interest every single year. Those that are paying interest, the bottom 80% of Americans, they don't have financial assets. They have debt. Well, the cost of that debt is skyrocketing, and so they find themselves on the lower leg of the K. Kind of zooming in on that topic, here we can see personal interest payments every year, $571 billion. That's $500 billion every year that the average American has to pay total in personal interest payments. Now, if we look per person in the labor force, that equates to $3.3 thousand per person. And if you look at that divided by the average hourly wage, this blue line divided by the average hourly wage, that is 106 hours of work. That equates to 13 days or 2.5 weeks just to pay the interest on your debt, not to pay the principal, just the interest component. And we can see it has gone straight vertical. If you go back here to say 2021, it was about 64 hours of work per year to pay the interest. Now it is 106, almost doubling. Again, the other way to think about that is that personal interest payments per capita are growing faster than the average hourly wage. Remember, that is how you read these charts that are dividing one metric by another. We'll see a pretty mind blowing one here in a second. So here is another way to think about it. Total consumer credit overall, $5.08 trillion. Now, one of the ways to examine the growth of the economy, remember, credit growth is essential in an economy, and private banks create 90% or so of the total dollars in the system, in the US financial system, in the US economy. About 90% of the dollars were printed by a private bank when they go to extend a loan. Therefore, we need to look at the relative rate of change of various types of credit. Here in green, we're looking at commercial and industrial credit as a share or relative to total bank credit. And what we can see, that's been declining from about 26% down to just 14% now. Again, what this means is total bank credit is growing faster than commercial and industrial credit. Now, again, consumer credit, 5.08 trillion. This rate of change, the annual rate of change of that total consumer debt, that used to be a pretty good predictor of the real GDP or the economic output of the US economy. However, as we can see, going back to the 90s, that correlation has broken down pretty substantially. It is very broken recently. We can see a bit of a K developing there as well. So this is really pretty amazing. Here we're looking at different interest rates. Now, the 10-year treasury yield is down over the past year or so, going back to Q4 of 2024. We had pointed out that the average interest rate on credit cards was 22.8%, is actually ticked up to 22.83%. Well, that is despite the 10-year treasury yield here in white actually going lower. Now, you can see, hopefully from this chart, that credit card interest rates are just skyrocketing, and they are going up again, despite the fact that yields like the 10-year treasury yield, which most of these are priced off of, is actually declining. And if you look at personal loans, the average interest rate there, 11.1%. If you look at auto loans, the average interest rate there, 7.5%. These are actually declining with the 10-year treasury yield. However, if we take a look at the difference between the 10-year treasury yield and credit card interest rates, we can see the spread has gone up significantly. If you just go back to the early 2010s, the spread there was only about 10 or 11% only. Now that figure is 18.7%. And in fact has gone up. So if we go back to Q4 of last year, the spread was about 17.8%. So even though the 10-year treasury yield is down, interest rates have gone up relative to that move lower in the 10-year treasury yield by a full percentage point. That is a big amount when you put it over the total amount of consumer debt. So it would take 161 billion hours of average work using the average hourly wage to pay off all consumer debt. And since 1971, consumer debt or credit, however you want to look at it, has grown 324% faster than the average hourly wage. Down here, we're looking at total consumer debt divided by the average hourly wage. Right now, again, about 161 billion hours of the average work in order to pay off all of the debt that consumers own. And again, remember, credit cards are a huge part of this issue, that floating rate debt. And again, remember, banks are raking in $280 billion in credit card interest every single year. And also remember, every time that personal interest payments as a share of the average hourly wage, per capita interest payments as a share of the average hourly wage reached about 105 hours, we saw a recession right after. So last time here in 2000, we saw it peak at 113. We got the dot-com bubble shortly thereafter, recession. Same with 2008, peaked at about 112 hours. We peaked back here at 115 hours, set a new all-time high in the hours of work the average American must work every year to pay their interest on all of their debt. And it has been stuck up at this elevated level of 105 hours. If you go back to the 60s and 70s, it was only about 50 hours. So this has doubled. Put another way, the interest component the average American is paying has doubled, has risen 100% faster than the average hourly wage. If you go back to 1960 or 1970, and again, it would take 161 billion hours of average work to pay off all consumer debt, and that debt has grown 324% faster than the average hourly wage. So, anyways, hopefully that was helpful, and I will catch you on the next one.